Hi everybody, Thomas here at Rebel Income. Looking at the largest and most recognizable names in the stock market for useful dividend paying stocks is an interesting exercise. Current economic conditions have begun to raise questions, even for some of these industry leaders, about the quality and sustainability of their current dividend payout levels. That's because dividend payout ratios have been increasing over the last few months as earnings per share have been under pressure. Today, I'm going to look at Microsoft, a tech giant that's actually on the opposite end of the dividend sustainability question. Their dividend is conservative to the point that from the perspective of practical income at the stock's current price, it could be called miserly. It took Microsoft more than 30 years of tech dominance to begin paying a consistent dividend in the first place. That started in 2013, and while they announced a dividend increase in November of last year, it followed their 10-year pattern of ultra-conservative increases. Today, I'm going to make a case for why I think Microsoft's management should increase their dividend again based on their current fundamental profile. At the same time, we'll look at the stock's current price pattern and consider what that means about the stock's bargain price. Before we dive into the details, I want to take just a minute to invite you to check out my Patreon page. You'll find daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades that I publish for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open positions as well as current market conditions. You'll find the link in the description area of this video. Take a look. I know you'll find something that you'll be able to use in your own trades. Microsoft has been following a steady upward trend over the past year, which we can see reflected by the 20-day moving average, which has been increasing steadily, as well as that really ugly line that I just drew, tracing the stock's rising lows over the past year. The stock has nearly doubled in price, going from about $220 per share in January of last year to its current level just a few days ago, where it marked latest resistance at about $415 per share. The stock has retraced back against that high since then to a low yesterday at about $400 per share to mark current support, with the stock sitting right at around $404 per share right now. That means that if the stock continues to rally, it's got about $9 of upside to that first immediate resistance level. And if it turns around and drops back, it's got about $4 of downside to that first current level of support. With that alone, we have enough to take a look at an interesting technical setup if you're looking for a short-term kind of a trade to think about reward to risk. With $9 of upside against about $4 of downside, that means that the current reward to risk level for Microsoft is above 2-to-1 on a very short-term basis. That's very interesting, even if you're just simply wanting to work with that current distance between support and resistance levels. If it breaks above 415, considering that is a recent 52-week high, the question becomes how much further could it rally? In these kinds of cases, I like to use the current distance between support and resistance as a benchmark. So if it breaks above 415, that suggests that its next high could be in the neighborhood of $430, giving it about $36 of upside from its current price today at around $404. If it breaks down below 400, on the other hand, the next question is where should it find next support? We can see a pivot high in November of last year in the neighborhood of about $385 per share, about $15 below 400. Even on that basis, then, you're still looking at an overall reward to risk ratio on a longer term basis of 2-to-1, with about $36 of upside against roughly $18 of downside. From a technical standpoint, that's interesting. Let's go ahead and take a look at the company's fundamentals, and I think you'll begin to see why I believe that the company has room to seriously consider raising their dividend. We can see that a year ago, Microsoft's free cash flow was sitting at about $57.4 billion per share. That's a very healthy number all by itself. That increased in the most recent quarter to nearly $67.5 billion per share. That's an increase of a little over $10 billion over the course of the year. By contrast, liquidity has actually decreased in the last quarter. We can see that it was $143.9 billion in the quarter prior and declined to a little over $81 billion in the most recent quarter. That sounds concerning, especially considering that it's a decline of about $60 billion in that time. However, there are a lot of reasons to account for that kind of a decline. It could be attributable to an all-cash kind of a transaction, which a lot of tech giants like Microsoft often engage in, as well as any number of other investments in their variety of businesses, such as OpenAI, Azure, their cloud computing platform, and more. The interesting thing and the important takeaway about their balance sheet and their level of cash is that with it still above $81 billion, compared against their current level of long-term debt, which is a little under $45 billion, the company could still pay off all of their current long-term debt and still have about $36 billion in cash left over. Think about that, $36 billion in cash after liquidating nearly $45 billion of long-term debt. Most companies in the United States, in the world for that matter, would give their left arm to be in this kind of a position. Microsoft also has a history of above average margin profiles, and the way that I like to measure this is by looking at net income relative to revenues. We can see that in this case for Microsoft it was at about 36.27% over the last year. That number is higher than the average for most tech companies. It did narrow somewhat in the last year to its current level at about 35.26%, but still remains very well above the industry average. Considering the increase in free cash flow and the still high levels of net income, we can see profitability for the company remains very high, as well as a continued fortress level strength in their balance sheet, even with the $60 billion decline in cash and liquid assets. That sets the stage for why I believe the company has room to increase their dividend. Let's go ahead and take a look at this. We can see that Microsoft's dividend yield is low enough at not even 1% to be considered an afterthought. That's not an unusual situation for this company, as management has been content to maintain their dividend yield below 1% for most of the 10 years that they've paid it. My case for increasing the dividend isn't just about raising the dividend yield to make it more attractive to income investors like myself, although that's certainly part of it. Their current payout of $3 per share per year takes up about $22.3 billion in expenditures per year. That is a big amount, but as we just saw, Microsoft also currently holds about $36 billion more in cash and liquid assets than their total long-term debt. That means they could still double their dividend payout today to $6 per share, or about $44.5 billion, pay the entire amount out of cash, and still have more than enough left to liquidate all of their long-term debt. Their operating and profitability metrics based on free cash flow and net income also suggest that even a 100% increase in their dividend payout could easily be absorbed by their cash flow alone. This chart gives us a good look at the way that the company has been raising their dividend on a consistent basis over the last 5 years. And the truth is this pattern goes back about the full 10 years that they've been paying their dividend. And it is impressive to see that they have been increasing it. However, the increase is relatively narrow. It usually averages about 7 cents per share per increase per year. The reason I'm showing you this chart is to show you how to calculate the dividend payout ratio. We can take the $3 per share per year payout and divide it by the $10.45 we see in earnings per share for the same trailing 12-month period. 1045, which is the number that we see in the top left-hand corner of this chart. When we divide $3 by 1045, if you run that through your calculator, you'll see that the number comes out to 0.287, or about 29%. Sustainable dividend payout ratios are about 50% of earnings. Now, if they were to double their dividend payout, they'd go a little over 50% in this case. But as I've just demonstrated, I think that even that level, going above 50%, would still be extremely sustainable considering the overall strength in their balance sheet and the improvement in net income, along with the improvement in free cash flow right now. Finally, I mentioned at the beginning of the video that we still want to consider whether or not Microsoft would represent a useful value at its current price. As I've already mentioned, the stock is about $404 per share, having nearly doubled in price over the course of the last year. That actually means that it's pretty significantly overvalued at its current price. My value analysis puts a fair value target at around $296 per share, meaning this stock is overvalued by about 29% right now. Considering the level of downside in the stock and the extremely modest dividend yield that is being offered right now, it's hard to make a really strong argument for trying to buy the stock strictly on the basis of thinking about income. That makes Microsoft a bad bet right now under current market conditions. Thanks everybody. I hope you found this useful as always. If you liked my content, please do go ahead and click here to subscribe to my channel. You can also click here to see another example of the kind of content I publish. Thanks again. I'm Thomas at Rebel Income. Talk to you again soon.